Yes, thank you, Odhiambo. Now it's your turn to dissect this topic. And now I don't think we will need to wait until next year to maybe have you again, like he's saying. But I know we've also met during the meet and greet. So for those of us who attend meet and greet when you are invited, can always come in and interact in person and share knowledge, network, and build relationship. Welcome, welcome. Um,
Thank you, Mr. Olale, and thank you, PP. CPA Jeremy is my name. Partner at SFI Kenya Prolific. So we are a member firm to SFI Global. SFI is Santa Fe Associates International. It's one of the top accounting networks in the world that we are very humbled and privileged to be a part of. So I was saying there is a difference between avoid and evade. And avoid is where you can be able to find provisions within the law that allow you to pay less tax than what you should. Of course, one of the contentious provisions in the Tax Procedures Act of 2015 is that they tend to, or the wording there is that they still want to make avoidance illegal. But for the purposes of our discussion, what we are saying is that how do I find something that is within the law that allows me to pay less taxes? And the first thing we want to say is that you want to be informed. This is a quote from Derek Bock that says that if you think education or knowledge is expensive, try ignorance. So you want to invest in, as a business leader, you want to invest in becoming the best that you can be. And I just want to give an example there. We know that, for example, one of the very contentious acts that we've had is the Finance Act of 2023, which was passed last year, and which, sorry, I think this thing was timed, which had a number of provisions. Of course, my position is that one of the people that are most hit by the Finance Act that was for last year is payroll. That is people on payroll. You will say salaried individuals, and of course employers. So people in formal employment, the Finance Act really did affect us. But that notwithstanding, you find that there are some very good provisions within the same act. For example, and that is actually something which is very practical that we can be able to employ in our businesses. Prior to this Finance Act, there was a cap, or there's what is called the capitalization, which means, simply put, if you borrow a loan from the bank, then that loan has interest. The interest component is an expense. So prior to this Finance Act, you find that there was a limit to how much of that you could charge to your profit and loss. And the limit was based on a figure that is which we call EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. But simply put, there was a limit to which you could be able to charge interest to your profit and loss account. In other words, even though you've taken a loan to develop your business or to take your business forward, you couldn't charge the entire interest expense as a capital, as a deduction, as a tax deduction. But now with the Finance Act, you find that as long as it is a local loan, there is still a cap on foreign loans, but as long as it is a local loan, then you can be able to charge the entire amount on interest. And that actually is one of the ways that you can reduce the amount of tax that you have to pay. That if you have borrowed and there is interest expense on that borrowing, then you can be able to say that out of my incomes, then I am charging this expense, that is interest expense. So you see why it is good to be informed, because you find that the Finance Act in this case came with some goodies, one of them being removal of the cap on what is known as thin capitalization. The other one is for people who are who provide exported services. Then if you charge VAT, so for example, if you are in IT and your client is outside the country and you're charging them VAT, you find that prior to this, to the Finance Act, you had to pay VAT on that service that you provide to someone outside the country. But that VAT is now removed with the Finance Act. Then you find that for landlords, of course, you now enjoy a lower tax rate, down from 10% to 7.5%. Of course, there was talk of a taxation of chamas and private motor vehicles, which I think was not very accurately presented. But the point here is that we want to be informed, that knowledge is power, especially when we are able to find practical application of the same. Then the other thing we say is that do not walk alone. This is a quote from the Loaded and Stuck of my favorite show, GOT, that when the snows fall and the white winds blow, the lone wolf dies, but the pack survives. Previously, we used to look at this case that was won by Kenya Association of Manufacturers, which I think is still a landmark case, because you know that this was the previous regime that intended to introduce 3% minimum tax, but which was defeated by that's Kenya Association of Manufacturers, RETRAC, and Senior Bus Association. But more recently, we have seen that with the suspension of the housing levy, for example, one of the people that have been quite vocal and that have therefore, in a sense, informed how entrepreneurs responded, this is very current, is the Federation of Kenya Employers, who said that, they issued a memo or an advisory saying, we are advising our members not to pay this levy because it has been suspended and therefore, and even declared null and void. So you see, the thing is, if you're walking all alone, then you are not as good as the person who is under an umbrella. And that's why, for example, it is good to be a part of Power Monday. And I noticed Power Monday was honored as one of the SME enablers, top SME enablers by ASEC. So we want to belong in such spaces. We want to try and not walk alone, because then we can be able to have a collective power to lobby for the kind of policies and the kind of taxes that we think would be important. But then in terms of our individual businesses, we also want to look at the value of relationships. And in this case, one of the things that I've seen to be very practical is in terms of what we call the tax point. So you will find that this used to apply for VAT, but now with the e-teams is also going to be applying for even income tax. And simply put, the point is that if let's say that I sell to you, the moment I sell to you and I issue you an ETR receipt, in this case, so that was for VAT, but in this case, whether it is ETR receipt, whether it is what we call Teams compliant ETR receipt, or whether it is now an e-Teams invoice, the moment that I issue that, then KRA expects that I have made that sale and expects me to pay. So what happens if I issue that invoice and you have not yet paid me? Then it means that I am actually going back to finance to finance. It's like I'm financing you really, or financing your tax. So for that, we usually advise, you know what, have a good relationship with your customer so that you only need to raise this tax invoice at the point in time where they are ready to pay. Otherwise, if need be, you can raise a pro forma invoice, which is somewhere between a quotation and an invoice, so that they are saying, well, we acknowledge that this is what we will pay, but we are not yet ready to pay. Now we are ready to pay. Issue us with your invoice. So that's part of managing your cash flows by ensuring that you're not paying tax before you should, before the time that you should. But you're only able to do that by having a good relationship. Then, of course, plan to win. And in this case, the thing that we are looking at is tax planning. You would want to be able to say, the assumption there is that you do you do financial projections, you do budgets, then you would be looking at, for example, the year 2024, what are my projected incomes? What are my projected expenses? What does my tax look like? In terms of costing, for example, if you are registered for VAT, then you know that there's going to be a 16% tax on each and every one of your sale. And you have to think, how does that impact my pricing? Do I want to determine that my pricing, for example, is 10,000, then plus VAT, meaning I push the entire amount to the customer? Or do I want to say it is 11,000, meaning we are sort of, each one of us is bearing that burden, and so on. Then maintain proper records. This is one of the most important things that you can do in terms of tax management, because one, we say that income tax is tax on profits, and profits is sales less expenses. So if you don't have a proper record of your expenses, then it means that you're going to be reporting higher profits than what you should, and therefore paying more tax than you're supposed to pay. But then even in terms of the taxman, even in the event of a tax audit, if you do not have proper records, then it becomes very, so if you don't have proper records, it becomes very difficult for you to prove that you actually incurred that expenditure. So you would want to maintain proper records before you have to pay someone, let them give you a tax invoice. In this case, if now effective 1st January this year, you want them to issue you with what is known as an e-Teams invoice or a Teams compliant ETR receipt, either way. But the thing is that you would want to ensure that every expenditure that you incur, you're being able to offset that against your sales. That is assuming you're under the income tax regime, which most businesses are under. The only person who may not be very concerned about that is someone who decides to, who opts for the turnover tax. That is 3% of your sales. But even then, you have to have very proper records of your sales. So either way, maintaining proper records is one of the most effective ways of ensuring that you're not paying more tax than what you should. Then the other thing is consider the tax amnesty. And I think at any point in time, there will be something to consider when it comes to this. Last year, I think we were talking about what we are calling the voluntary disclosure program, which is now over. But now there's the tax amnesty. It runs up to June 2024. It allows you to get a waiver of penalties and interest for the period up to December 2022. But then you have to pay any principal taxes that are there. But in the event that by this June 2024, you find that you're at a place where you may not be in a place to have cleared the principal taxes, that you can still engage the taxman to enter into a payment plan, which ideally does not exceed 6 months. Then the other thing to consider is tax reliefs and exemptions. There will always be a number of these. Top of the list is personal relief. If say you are a sole proprietor or an employee, this is just automatic. It is deducted as your employer is filing for pay as you earn. But if you're a sole proprietor, then it means that the first 288,000 that you make is not subjected to tax because there's a personal relief of 28,800. I've also seen, oh yeah, it's there, so I'll come to that. Then there's a mortgage relief of up to 300,000 per annum. If you've taken a mortgage, then there is a insurance relief. This is where you have a life policy or an education policy that is more than 10 years. Contributions to a registered benefit scheme. And by the way, what I've seen very many people doing, if you, I don't know whether this is something which you've had someone talk about, these NSSF. So like your contributions to NSSF, they are tax exempt. And it's not just NSSF, it is also any registered pension scheme. So you know, with the NSSF, what happens is that there is what is called Tier 1 and Tier 2. And there are many companies that are opting to have someone else take care of Tier 2 other than give that money to NSSF. So it's a provision within the law that you can actually be able to get the Tier 2 going to a registered benefit scheme other than NSSF. Either way, whether it goes to NSSF or to another body that is registered, then you find that it would still be exempt from tax. Then contributions to a home ownership savings plan, the first 150,000 per month for the disabled. So if you know, or someone who has but you have to get what is called the PLWD certificate. You have to be able to have that that proof that you're a person living with disability. Then you get a tax compliance certificate, and then you are able to have up to 150,000 per month exempted from taxation. Then if, for example, you're providing meals to your employees, up to 4,000 per month per employee, that is exempt from tax. And also per diem of 2,000 per day, 2,000 shillings per day per employee is also a tax relief or exemption. It's not subject to tax. The other thing we usually say is that you pay yourself a salary. This usually assumes that this is your only source of income. If it's not your only source of income, it may not save you for tax. And the simple reason why paying yourself a salary saves you on tax is because it goes as a tax saving of 30% on the business. But for you, you pay payee on that salary at a graduated scale. So in that sense, you find that you're saving. Although the saving is minimal, it is up to, I think now up to 33,000, where 33, anyway, between let's say by the time you hit 50,000, then there is no more gain because then you have hit the highest brackets. Yeah. Then if you have business assets, it's better if they're in the name of the company than in your personal name. That way, then you can be able to claim depreciation. For example, if it's a motor vehicle or furniture, computers, and we are assuming in this case that, of course, the company is a limited liability company, which is a different legal person, then you're able to charge or to claim what are known as capital deductions. We simply call them depreciation. And also you can claim expenses. So for example, motor car fuel, the repairs, all that. The only thing is that usually it is recommended that you write back 30%, which means then that what you end up claiming is 70% of the associated expenses. What that means is that, for example, if you if you have that car that you're using both in business and for your personal use, the assumption is that 30% of the times you're using it for your personal use. You're using it to take your family to church or to go and visit your family up country. So, but 70% you can be able to charge to the business as an expense. Then beware of legal pitfalls. I think this is a very good one to consider now, especially in the wake of high payroll taxes. There are many people who are asking, can I therefore change my contract from employment to consultancy? Now, the consideration there is what is known as the MICE test. So MICE stands for mutuality of obligation, integration, control, and economic reality. So mutuality of obligation, do you have an obligation to provide work? And does the person have an obligation to do the work? When you think of an employee, in a sense, you are obligated to give them work because they won't come to the office and sit doing nothing, but you don't have such an obligation for a consultant, so to speak. A consultant, you only provide them the work if it's there. If not, then you really have no obligation, so to speak. The other thing that is considered in determining whether someone is a consultant or an employee is integration. How integrated into their business, into your business are they? Are they an integral part of the company? And the other thing is control. So when you think of integration and control, you think of things like, can this person invoice another client for the same service that they provide to me at the same time as they are providing that service to our business? All right. So let me use myself as an example and say that to determine whether I am your employee or I'm a consultant to you, I'm providing you a toast accounting service, for example. Then can I, at the same time as I am providing you accounting service, provide the same to another person? Can I invoice another client for accounting service at the same time as I am providing the same to you? If so, then I am most probably a consultant. If not, then it tilts the scales towards considering me as an employee as opposed to a consultant. There will be things like, am I housed in your, or do I work from your premises? Of course, that I think is changing now post-COVID, but that used to be a major consideration. Does this person have an 8 to 5? Do they report at your premises? Then is equipment and economic reality. So for example, do I use my own equipment or do I use the equipment that is provided by your company? Like, do I bring my own laptop or does the company provide me with a laptop? If I bring my own, I am most probably a consultant and otherwise, and vice versa. And then economic reality is how dependent am I on this particular job for my upkeep? Is it my main source of income, or is this just one of my other sources of income? So there will be those considerations. And well, I dwelt there a bit because I think in view of the very high payroll taxes, that question has kept on coming up. Should I change my contracts that I have with my employees to consultants? Then if you do, you want to be sure that you don't change that to consultants and then KRA still comes and claims pay from you, and yet you didn't deduct whatever deductions you should have made, especially on pay, housing levy and NITA from the employee. Well, this is what we call the specified sources of income. It is a pitfall that you will find yourself in, where maybe so according to the taxman, these are the sources of income, the various categories of income that you'd have: business, farming, rental, interest, and commission. The point there usually is that if you're making profit on rentals, for example, or you shouldn't offset that against losses in the business. Or if you started farming and farming is making a loss and the business was profitable, you can't offset the two. So that if one is profitable, you pay tax on that. If the other one is loss making, you carry forward that loss to the other year. Speaking of losses, it's another reason why it's good to maintain proper records, because especially when you are starting a business, rarely do you have a business, if at all, that breaks even on day one, which means that there is capital that you have to introduce. Now, if you don't have a proper record of the capital that you introduced, the day that you're profitable and you want to recoup that investment, then the taxman is going to view that as director drawings. They're going to view that as if you are paying yourself, while in fact, number one, you financed the business, and therefore it's just like a loan. But if you don't have proper records for it, it doesn't show as such. Secondly, if the business has taken time to break even, that it was in losses, you would want to be booking those losses so that the day you're profitable, then you offset before paying tax on the profit. You say, even though I've made a profit this year, last year I made a loss, and the year before. So before I pay tax on the profit I have made now, I am offsetting against the losses that I made previously. Then this is something you would want to do. It's just like a quick health check that you can just do yourself. If you simply go to iTax, there is a section there for where you can be able to confirm your PIN status. And what you see here, for example, when I did this for our business, we simply used, we previously used to exist as Prolific Business, but now we are SFI Kenya Prolific. But you can see the various obligations we have: income tax partnership, VAT, and payee. So in the event that, for example, you're not aware that you have VAT and payee, then you are incurring penalties on them every month, 10,000 for each every month. That's 20K per month. In 1 year, that is a good 240, simply by not knowing. And as they say, ignorance is no bliss, or is no excuse in law. So you will want to ensure that you are confirming your PIN status. Then in closure, do not claim ambiguous expenses. As I mentioned, especially now with effect from January this year, ensure you're getting an eTIMS invoice. When you're filing your annual income tax, whatever you claim as salaries and wages, ensure it tallies with whatever you declared as pay as you earn. By the way, whether it is more or less, it still lands you in trouble. Then whatever you show as your annual sales at the end of the year, ensure they are agreeing with whatever you were declaring as your VAT output. Avoid other red flags such as perpetual losses. That will be something that will, or perpetual VAT credits. That is definitely something that is going to be attracting KRA to you. But when you think about all that in one word, it still boils down to maintain proper records. So that would be all from me. Thank you very much for listening. Once again, this is CPA Jeremy, SFI Kenya Prolific. We are a member firm to SFI Global, that's Santa Fe Associates International. We provide service in tax planning, advisory, and returns, and also cloud accounting, that is QuickBooks Online Zero, and I've actually left out Zoho Books, which I think is doing a very good job in these markets. Thank you, and back to you, OPP.
Yes, thank you, CPA. You know, when we were sharing this topic on social media, on WhatsApp, somebody told me, well, somebody from KRA told me, "What do you want us to collect?" I told her, "I've not said you should not collect. I've just said we've just said how to avoid. You see."
Yes.
Somebody said, "Hey, I'm feeling uncomfortable sharing this." I said, "No, there is nothing illegal here. We are just going to educate ourselves." So I love the topic, and I love those incentives. You know, I would call them incentives because generally people would pay for what they don't know just because they fear KRA. What do I do? What do I do? And I think a big part of it includes having an informed CPA. Yeah, so thanks for that, and you are one of those informed CPAs. There are a couple of questions which we will handle, and then we will see how many of them we can handle within the time. One, actually two of them from Melvin Lima, Dr. Melvin, you know him. What is the cost of onboarding to the eTeams platform, and is this tax deductible expense? And maybe, I don't know, you want to handle them one at a time?
I can take both of Melvin's at a go.
Yes, the other one from Melvin is, where and how does one get onto the eTeams platform, and do you need an ETR machine if you are in a service industry that is not vertical?
All right. Thank you. And always a pleasure to have Dr. Melvin, a very prolific mentor he is. Now, when it comes to eTeams, if you remember what happened that late last year, that's late last year, but one is that they made us purchase gadgets that we didn't need, unfortunately. That is the eTeams registered ETR machines or eTeams compliant. So if the Teams compliant ETR machines, which basically means that right now, if you have that Teams compliant ETR machine, then you are good as far as being Teams or eTeams compliant is. If, however, you didn't get that ETR machine then, and you register on eTeams, you do not need an ETR machine because they are serving the same purpose. That if you didn't get the Teams registered ETR machine and you now register on eTeams, then you do not need to get an ETR machine. Again, if you are in an industry that is not does not need where you do not charge VAT, that's the point. If you don't charge VAT, you have never, there's no need for you to get an ETR machine. The eTeams registration is free. KRA, they are not charging for registration of the eTeams. Of course, if you come to guys like us and we have to go to KRA on your behalf, we will charge you for our going. That is Yamafuta. We will charge you for that. But KRA themselves, they are not charging. If you take yourselves there, they are not charging. They are providing the service for free, which then means I don't think it can be a tax deductible expense because the expense really does not exist in that sense.
Thank you, thank you, thank you. Now, next is from Susan. Susan is asking, what is the current position in regards to eTeams for people and businesses below the 5 million threshold?
All right, so KRA has said they are going to provide guidelines for that. But what we have seen so far, according to, so we were relying a lot on the draft provisions, the draft eTeams provisions. And the draft eTeams provisions, by the way, didn't have anything to do with the 5 million. But when they did the final provisions, when they did the final regulation, we saw that the final regulation was exempting businesses that are below 5 million threshold. Now, the thing that let me say we've not quite agreed on the interpretation is that they talk of supplies. So supplies, the word we were asking is whether that then means goods or whether that means services as well. But there is that provision that if you are below 5 million, then you do not need to to provide an eTIMS registered or an eTIMS invoice. Of course, what that means is that it really opens the door completely, because otherwise you can always, come the end of the year, you see, if everybody, for example, was inside eTIMS with no exception, then come the end of the year, it would simply be that if whatever expenditure you're claiming is not on eTIMS, then we know it is not genuine, or it is not allowable. Let me not, I think genuine is a bad word in that case. It's not allowable. But if they, as they have done, opened the door, you can always say, well, this I bought from somebody whose threshold was below 5 million, and therefore they really didn't need to provide me with an eTIMS invoice. But we still expect more guidance in that space, which they have, because what they said, why I'm saying that we are waiting for more guidance, is they say that they were going to come up with another system for that particular niche that is below 5 million. But that is what we have currently.
Okay, thank you. Another question from the same person is, if those below 5 million are exempted from providing eTIMS invoices, will there be invoices or receipts they issue, be allowed for tax purposes for the customer who purchases from them? And I think that is what you are talking about, that there will
Yes,
be
yes,
another
yes, yes.
system because then it means that there will be some loophole if they are exempt and something like that. So we can move to another one from Christine Gikonda. Is the housing levy still deductible from salary, considering that it has been declared unconstitutional? Yeah, you touched on that briefly about associations. So where I think Federation of Kenya Employers or Kenya manufacturers say, advised their people not to pay. What do you say about that?
Yes, yes. FKE said do not pay. So what I think what somebody is saying is, the question has been, what if I'm not a member of FKE and I fail to pay? So the thing about these governments, which we have seen to be very unique compared to previous governments, is that you notice the same housing levy. Remember when it was introduced, on month one, it was suspended because there was a case in court. I think it was Omtata. And what happened was that when it was suspended, then the court, that is because there was a case that was in progress. Then that is at inception. Then eventually the government won. And then they did something which is unprecedented. We say we've never seen that before, where they did back taxes. They said, you know what, even though it had been suspended, the Finance Act was actually effective 1st July. So if you remember, there was a situation where it was where the deduction was made for 2 months, and which really affected some payrolls. So in this case, I think there is still that fear that even though it's been declared unconstitutional, should that be reversed, then this government will still want to go back and claim even the period where it had been declared unconstitutional. So let me just say that we find ourselves in a quandary there, because and I can't say either deduct or not deduct. The thing is just to understand that, well, according to this is the position that it's been declared unconstitutional. Bodies such as FKE said, given that, do not deduct. Of course, also we've seen a good number of MPs not only saying do not deduct, but saying that we should have refunds of whatever had been deducted. But then on the other hand, the risk would be that if we fail to deduct and then again, it is, it is reversed. You might expect some back taxes. But the thing that I see in all of this, as I mentioned earlier, is the need for us to exist in groups where we can be able to lobby that, for example, we say do not deduct as FKE has done. It is not my business versus the government. It is actually a body, a system versus a system. That is what I would say regarding that, Christine.
Thank you, thank you. Yeah, let's move on to another one from Netra. Please expound on the consultancy. Do we withhold some tax when paying for consultancy services as a company?
Yes, that's correct, Ntera. If the consultant you're paying, if whatever you're paying them is above 24,000 shillings, then you're supposed to withhold 5% withholding tax. And that is for residents. Other rates apply for non-residents, which is starting from 20%, but then depending on whether there is a tax, that's a double taxation agreement, the tax rate could be lower. But generally, assuming that this is a local consultant, then if you pay them an amount that is above 24,000, you should withhold 5%.
Thank you. Now, maybe just a follow-up on that. If you are paying them this amount in bits, let's say you are paying 100,000 in a year. You paid
Mm.
them 10,000 here, you paid them 20,000 there. So all of them were below. How
No, it's
that has
24,
always been this
24,000
24, is
in a
it a
month.
month or is it a year?
No, it's a month. 24,000 in a month. Sorry. I think I should have
Yeah,
clarified that.
I think that has been a problem somewhere. Okay, so
Yes.
because some people start claiming, it's a year. No, it can be
Oh,
a year.
sorry about that.
Okay,
Yes, it's
yeah.
24,000 a month.
Okay, from Dick Okite, what happens when you declare that your estimated turnover is below 5 million, but then ends up being above?
So, what is required is that the point in time where you notice that you are about to hit 5 million, then you register. So the assumption there is that you are tracking your incomes on a continuous basis so that you can say in a given year of income, for example, we are in the year of income 2024, if, maybe you're just doing what? Maybe you're doing 200,000 every month. So by June, you've only done 1.2 million. Then you come across a big deal in July or August, which makes you hit 5 million. Then you register at that point in time. And if you register at that point in time, then the amount, the sales before the registration, they are not subject to VAT. But if you fail to register and the end of the year, then you end up showing that you actually made above 5 million, then they expect you to pay, or they'll come demanding for tax on the entire sales for the year.
Now, also a follow-up on that. There are
Yeah.
situations where you register for VAT on that estimation that you're
Mhm.
going to be doing 5 million, but then you never do it. You end up maybe 1 million, 1 point something, or less 1 million. What happens? Are you stuck there with
Yes, you
your
are.
registration, or you can reverse?
Unfortunately, okay, in theory you can reverse, but practically it's not been very easy to remove a VAT obligation once you have it. And which is why, by the way, we recommend that if you find that you're about to register for VAT, register that in a company, not not on your individual PIN. Even if you're a sole proprietor, then incorporate at that point so that you have a different PIN for that business, and that is the one that is now subject to VAT.
Okay, great. Now, another one from Pius. How do you treat VAT when computing P&L? Is it treated as an expense? And then
Um,
he's asked another question. question just now, which I think is fairly straightforward. Also, you can add which services are not vatable.
All right. Okay. No, VAT is not treated as an expense. What happens is that it is, as the word suggests, value-added tax. So you will say that if, for example, I determined the value of my service is 10,000, then I will say 10,000 plus VAT. So I invoice you 11,600. Then you pay me 11,600. I take my 10,000, which I already determined to be the value of my service, and the 1,600 that I collect, I simply collected that on behalf of the government. Then the services that are not vatable, they are categorized into two. There is exempt services and there's exempt services and there is zero rated. So exempt services will be like what Dr. Dilima does, that is, hospital, medical services, schools, for example. Those they are not subject to, they are exempt. Even banking services, those are exempt. Then zero rated will mostly be exports. Exports are zero rated. So those are the kind of services that are not subject to VAT. There's usually an entire schedule, but generally things like medical, education, those are exempted, and something such as exports, those are zero rated, so you don't pay VAT on that.
I think we've exhausted our time, and so we may need to bring it to a close there. I will invite somebody to give a vote of thanks, and if we have, I don't know, is Caroline Mwazi here? You can give a vote of thanks on our behalf. I know you are here.
Okay, allow me not to show my video. I'm sitting where the light is behind me, so you can't see. Just to say thanks to our speaker today. Many people are intimidated by tax. Many people find it difficult, but it's very necessary. And I like the simple tips that you shared, especially the part about keeping records. That's where it all begins, and everything else follows from there. So thank you, Jeremy Rugunya. You've given us a lot to think about. Thanking each and everyone also who has joined the session today. Power Monday wouldn't be Power Monday without you. You're the ones who make Power Monday, and of course the rest of the team that has been supporting in the background. Let's keep Power Monday going. Asanteni sana for joining. Thank you.
Thank you very much. Now,